Welcome, everybody. Welcome back to the Elite Real Estate Podcast, where we cover everything there is to cover about real estate: the insides, the outsides, the mindset, the ins and outs of real estate all together. And I am honored to have a special guest join me today, Mr. Lon Welsh. How are you, my friend?
I'm fantastic. Thank you for having me.
Absolutely. Thanks for joining, and very excited to get you on here today. I know the success you've had in the real estate realm, and I know we're going to talk about how easy it is, right?
If only.
Yeah, right. If only it was as easy as we think it is, it'd be even better. So, I
Right.
mean, just to start us off, Lon, how did you get started in this business? You know, you've been in this for a while, and where did it come from? How did you get to where you're at?
Gosh, when I got out of grad school, I worked as a strategy consultant for 8 years, first at Deloitte and then Accenture. And I was filling out my documentation to sign up as an employee with Deloitte, filling out this 401k thing, and was trying to backsolve for like how big of a stock portfolio I would have to be able to have the retirement that I wanted when I wanted to retire. And there was like no possible way to compute that equation. So I started doing some research on investment real estate and said, this is the only way it's going to happen. So that's really what got me started.
I love it. I love it. And again, sometimes when you start to figure this stuff out, and real estate especially, you can make a lot of money, you can lose a lot of money, right?
Yeah, I can.
It's a two-way street, rather quickly, right? It's and I know you coach and train agents. I coach and train agents on a daily basis, and it's one of the funny things we talk about momentum in this business, and it's momentum that can pick up quickly or stop abruptly.
Exactly, no doubt.
Yeah, yeah. So just to start off, so give me your story. Where are you at now, and how did you get to where you're at as far as your investment portfolios and all that?
Yeah, so I'll kind of give you the, maybe 3 or 4 minute long answer. So I worked as a strategy consultant for about 8 years after grad school, and got a real estate license while I was doing that because I wanted to start investing, and couldn't find a realtor that I really liked a lot. From an investing track, I've been an investor for just about 25 years now, mostly multifamily and office. I've done some development, but mostly like just buying an existing asset, renovating it, renting it out, refinancing, taking the cash out, and repeating. So at one point, I had about 140 doors. So I've since sold most of those. I'm mostly investing passively now, and I can talk about that more later. After working as a consultant, I started my own real estate brokerage, and I've been a broker now for 22 years, I guess it's been. So I started a company called Your Castle Real Estate. We ended up becoming the largest independent brokerage in Colorado, a little over 750 agents. And then I built a title company with a friend, Personalized Title. I sold both of those about 3.5 years ago. The brokerage I sold to a private equity fund, and the title company I sold to Compass when they were throwing money out of helicopters at people. That was a fantastic transaction. And then about 3 years ago, I started a company called Ironton Capital to help people invest in real estate passively. I had all these years where I ran classes on real estate investing, and I have 20 people in the class. One of them would go buy an apartment building with me. The other 19 would say, makes a lot of sense, see all the logic. I don't have time to do this, but thank you for the class. So now I've got, a service that meets the needs of 19 people instead of one person. So I don't know why I didn't think of that a little sooner.
Yeah, it's true, right? And that's one of the questions that lead me to so it's kind of like, how do regular people actually build wealth, through real estate? Like, if somebody today were just to start, I want to build wealth in real estate, how would they go about that?
Well, there's really two tracks. Historically speaking, if you were an active investor, you'd go buy a rental property and be the landlord or hire a property management company. And over time, there'd be a lot of appreciation. You'd get some cash flow from operations. And historically, in theory, that's like 80 or 90% of people would become millionaires from that method. And I have no reason to doubt that that's true. Um, in a lot of places now, Denver, as an example, the prices have gone up so much so fast. While the rents have gone up, the prices have gone up a lot faster, and it's difficult to get things to cash flow at all. And with the interest rates being where they're at now, very, very few things cash flow. Also, I think the huge gains in appreciation we had over the last 12, 15 years are unlikely to continue over the next 10 to 15. And we could talk about that if you're curious about why that is. So it's not quite as profitable, at least in Denver, to be an active investor. That's why I started a company to help people invest passively, get good returns, 17, 20% a year, and then not have to deal with the headaches. So for most
Yeah.
people, that the passive approach works better for them now. That won't always be true. The market always changes. Eventually, active will be back in favor. You'll make more money doing it that way if you have the time to do that.
Yeah, it's funny, and it's like you brought that up about reading the market, and it is true. It prices in, I'm in the Metro Detroit area, so prices are more favorable here that probably than they are in Denver, right? Because I know what's happened in Colorado is crazy as far as
It's
pricing goes.
nuts.
Yeah, it's crazy. But it is a little more favorable here, but still you still have the same cost, you still have the same idea of now, and because people originally think about buying a house and renting it out as passive income.
Hmm.
And some investors are like, "That's not passive income. You have to
That's
take care of
active
it."
work.
Yeah.
Even if you have a property manager and you hire out shoveling the snow and doing the maintenance, you still have to coordinate all those things because, the typical experience that I hear very frequently is a typical property manager lasts about 12 to 18, maybe 24 months, and then you aren't getting the service that you wanted, and then you've got to go hunt for another one, and you're always supervising them, and you are still the one on the loan who's responsible if things go wrong. So even though it's passive, relative to your day-to-day job, it still has responsibilities and risks.
Yeah, yeah. And it's thinking about, like, how do you actually build wealth, right? So if I were to start investing today, right? If you were headed out to the world today and brand new, right? You were just starting over again, and what would you do with $50,000 right now?
Typically people that invest with us, we have an income fund. It pays about 12% per year, so you get a quarterly dividend payment if income is what you need. Or we have a long-term growth fund that's in diversified real estate, usually about 30 properties in about 10 different states. That's tied up for 5 years, and our goal is about a 17 to 20% annualized return. So that's, for most busy professionals, that's an easier path.
Yeah. So talk to me about that. Like, what would that look like from you? Like, would it just I just call on and say, "Hey, I want to put 50 grand in"?
Yeah, you could reach out to me, and then what we would do is we've got a webinar and a little, PowerPoint presentation for both funds that explain how they work, and then schedule time to talk to one of us, and we'd be happy to answer all of your questions or your spouse's questions. And if it's a fit, we'll send you the sign up docs, and away you go. It's actually really simple.
And that's one of the most incredible things I feel like about technology and what you've adapted, because it used to be very cumbersome and hard to invest in real estate, right?
It
You
was.
you had to go find a property, like you said, and then you had to rehab it. Then you had, and that's still possible today.
Oh
But
yeah, absolutely.
yeah, but if you're a busy professional, do you want to go do all that, or do you want to just invest?
You probably don't. So I think the intersection where active investing, at least in the Denver market, makes the most sense is someone who is a real estate professional and they're out in the market all the time anyway. And then what you'd want to do is build a book of investors that are interested in looking for fix and flips or for rental properties. And you're out there just scouring the market to find those along with whatever other clients you have. And when you find it a particularly good one, you may cherry pick it for yourself because it's a match for your portfolio. But what you tend to find is that if you know 10 different investors, you being one of them, you'll have 10 different sets of requirements. And what works great for you wouldn't work for the other nine. And frequently, what works great for Bob or Sally doesn't work for you. But it doesn't mean it's not a great investment. It's just not for your parameters. And as an early person in my real estate career, that's a lot of what I did. I was always just looking for properties, and I had a big list of people I would give properties to if they didn't match my needs.
It's so interesting, and it's kind of comes circling back to some of this stuff too. Like when you're analyzing properties, and right, and I did some research, and like you've analyzed over 70,000 properties, right?
Oh,
That's just what the internet tells me.
I don't know if it's 70,000, but it's definitely well over 1,000. It's thousands.
Yeah, thousands, right? So what patterns have you seen that a lot of investors tend to miss?
Well, building the Excel sheet to do the cash flow model, whether it's a fix and flip or a rental, is relatively easy to do. The assumptions that you use to populate the model is the hard part. And if you're brand new, it's really hard to know, what's it going to cost to replace a hot water heater? What things could go wrong while I'm doing it? What's a reasonable amount to get for rent? What's a reasonable amount of time that the unit might be vacant in between two tenants? That's going to be a different answer in the summer when it's really easy to rent than it's going to be in the winter when it tends to be really hard to rent. I think, having good quality assumptions is probably the biggest thing that tends to ambush people. And then I think probably a secondary one would be trying to run a little bit too lean, not having enough cash reserves. And then if you do have the misfortune of having two or three hiccups in the road, then you're kind of in a bad situation, and that could be very uncomfortable.
Yeah, yeah. And have you seen that? Is like when we've had all these issues with supply chain issues and all that, like how bad can that throw you off if because we talk about ductwork or plumbing or any of that stuff. How much do you inflate or deflate for that stuff?
Well, I think it's important when you build out your budget for a remodel that you try to assign a contingency on a line item basis as opposed to just putting like a blanket 4%
Mm,
across the whole spend. Because some things you can really figure out with a high degree of certainty up front. Like if you need to replace all the kitchen appliances, you can go to Lowe's and get a hard bid, and it's going to come in at that. You're not going to be ambushed by that. As opposed to if you've got like an old 1905 Victorian where you've got lath and plaster walls, you're going to have to open up the walls, change out plumbing, and once you get in there, you're going to find other problems. Plumbing in an older building, I'd want to have a very wide contingency because it's a lot harder to predict in advance. And then there'll be some things that'll be kind of like a medium level of uncertainty, like maybe you have to replace the furnace and air conditioning system, and you've done 3 of those in the last year, or you've got friends who've done 3, and they can give you pretty decent bids, and the houses are roughly the same size and complexity. You'll need a contingency on that, but not nearly as big as the plumbing, but more so than the appliances. And if you can document your assumptions, why you pick those numbers, after the project is done, do a post-mortem and then write down, well, where was I right? Where was I wrong? The next time you do this exercise, you'll be a lot more precise. And the more of them you do, the better you get. And it's not about the model getting better. It's about the assumptions getting better.
got it. Got it. And so when you're looking at this stuff, do you have this broken down to like square footage? Like if I have a ranch that's 1,600 to 2,400 square foot, I kind of know about where I'm going to be.
Yeah, when I was buying single families or condos, we had a lot of good rules of thumb like that. Now there's 3 of us full time that are evaluating buying apartment buildings or buying warehouses, but we've got a lot of similar rules of thumb that we use for renovation work. How much can we raise the rents? What would the cost of rebranding the property be, or whatever other line items we have to evaluate.
I love it, and that's one thing I want like listeners to understand is like how much homework goes into this.
It's quite a
That
lot.
yeah, yeah. Like this isn't just a shot in the dark of hey, let's invest in this property.
Yeah, you're gonna wanna have some gating criteria up front that you can do so you can say no very quickly to the vast majority of projects. So the ones you have to underwrite in depth is relatively small. So, you wanna try to get to where maybe you receive 60 or 70 properties, maybe you only look at 8 of them in depth. You underwrite those, you fly out to go see 6 of them in person, and you make 1 decision to buy. That's probably a pretty typical funnel for us.
I love it. And again, it's a lot of work and a lot of effort. That's why, and I because as a realtor, a real estate agent, I get approached all the time. People want to invest, and you have to have this serious heart to heart conversation with most people about it's not a great idea, for you to invest in this, right? Because of all, like you said, there's a lot of back end. I've done a few flips, and what I did for a year before I even decided to do one was I got with one of the best guys in the area and just shadowed him for a few times. I even asked him. He shared his spreadsheets with me, like you said, right? The Excel spreadsheets of
Mhm.
appliances and cabinets and all the things, and how to keep track of it. But I did that for about a year before I even did the investment.
Excellent. I imagine you probably had a much higher degree of success than as a result. A lot of people just sort of like, not an impulse, but close to go out and just buy something and they don't do all the work.
Yeah, yeah. And actually it's funny, our very first one that my wife and I did, we made about 75,000 on the first one we did. And
That's great.
but it was because of all that homework I did before that.
Right.
Yeah, yeah. It was all that
That's
homework I did before
fantastic.
that.
Good job.
Thank you. Thank you. Um now we're headed into some weird times, right? Like economic times, things are changing, inflation, rate hikes, right? Political instability, all the things are happening. And you're seeing what inflation is doing out there in Denver to the homes in Colorado is insane, right? So
Mhm.
is there a way, or is there a way you're thinking to hedge against all that with real estate? Like, is there a way to stay in front of that with real estate?
The CPI, the Consumer Price Index, which is one of the broad measures of inflation that the Federal Reserve likes to look at, is based on the typical pattern of spending of a normal household. And the biggest spending category for most households is housing. So, rent or your mortgage payment is actually the biggest component of CPI. So, real estate will not only like follow CPI pretty accurately over a long time. Real estate drives CPI because it's the biggest part of it. So over a long period of time, you'll do better than inflation by a point or two on the value of the house. So it's a good inflation hedge.
It again, it goes back to doing that homework, right? Yeah, this is a full-time job, everybody. Like, this isn't just something to hop in and start doing, right? Unless you have, processes in place to do that, right? And now you focus right now. Ironton Capital focuses on sponsored like syndications, right? Is
Yes.
that fair to say?
Yeah, we're sort of like a mutual fund, a syndication. So when we can write a check for 500,000 or $1 million, we can negotiate a lot more favorable terms than if we're just writing a check for 25 or 50. And a lot of these funds have a large minimum. They may require a minimum investment of 1 million or 3 million. So as an individual investor, you can't get access. It's only for institutional access. And then finally, that we're able to get access to some deals that just nobody sees at all. So one of the sponsors we like a lot is called Provident. We've invested with them a number of times in the past. They've got a friends and family list. So when they've got a new project, they'll send it out to us. If we don't fund it for them, then they'll do a whole bunch of different publicity things to gather the cash they need for the equity side of the project. So there was a really attractive industrial project that came out a couple months ago on a Saturday morning. It took me like 15 minutes to look at it and say, yeah, we definitely want to be in that. So I sent them a note saying, I'll take 250,000. I can probably take 500,000, but I need to talk to investment committee on Monday. It was all gone by Sunday afternoon. Nobody saw it other than the friends and family group. So one of the things we do is we can give access to our passive limited partners to deals they wouldn't be able to see and get better terms than they would normally get. And those better terms pay for most of our fees. So we're not working for free, but it definitely reduces the cost impact a lot.
I got it. I got it. And so, like, if you could explain that to somebody out there that's listening right now that is has $50,000, right? Let's just to just throwing a round number out there, like for them to start, like, what would that look like to them to start in something like that with you guys?
Well, if you do the income fund, you'd be getting just a little less than 12% per year return. So just to make the math easy, we'll say it's $6,000. So you'd be getting a check for $1,500 every quarter for as long as you've got the money in the fund. So the income fund has no appreciation; it's all income. So for people who maybe they've retired or they just sold a big investment property and they need to replace that income because they were kind of relying on it, that's a really great solution. For people who are younger and still in the asset accumulation stage, then the long-term fund, you could put 50,000 into that. And it's just like a mutual fund. You're going to have a small sliver of about 30 different properties, about 10 different states. And our expectation is that we're going to have one that's going to be just a complete disaster. We're going to have one or two that are going to be home runs, like, oh my God, I'm so glad I invested in that. And a bunch that come in like more or less on plan. Just like if you bought 30 stocks, like you're going to have one Nvidia, but you're going to have one that's not. And they all sort of blend out. And we want to try to diversify the risk away. But it's simple for the investors. They just write the one check, and then we have to do all the underwriting and research after that. That's what we do full time.
Yeah, yeah. And how many people do you have in your group right now? Investing and or does it vary by project?
In composite, we're about 93 million that we manage, and it's probably right around just a little under 400 investors, probably.
Okay, okay, yeah. And again,
So we're
again,
not like
doing
a
the
Wall Street fund with multiple billions, and you're just like a serial number that's 10 digits long. I know almost all of our investors, and we do quarterly calls, and they call in with questions, and I talk to them, or they email me with questions, and I'm very easy to access.
which is different than most.
Yeah,
Which is different than most. And I want people to understand that part too. Like a lot of times with investments, it's kind of just give me your money and I'll call you. I'll give you
see you
maybe
in 5 years.
yeah, that or maybe we'll talk once a year, right? We'll have a little Zoom once a year, and then I'll tell you how everything's doing, and then I'll see you in 5 years. Um,
Yeah, we do quarterly updates for our investors on each of the funds. So we do a written report as well as a webinar for Q&A. So that covers most of the questions, but we always can do stuff like, ad hoc whenever you want as well.
yeah, yeah, and again, that's just starting out, right? So that's one of those big things that I want people to understand is again educate yourself, right? Learn about these things, but Lon, I think what you're explaining too is you guys are the education too, right? That you're
Right.
providing that as well as the investment piece.
Yeah, when we finish off a fund, we'll do a webinar for the limited partners saying, here's the 9 investments that we selected, and here's the business logic of why we're excited about it. Here's where we think that submarket's going to be able to go over the next 3 to 5 years. And then that investor with their financial team has 10 days to go review it all to commit. Or if they don't like it, they can tell us, hey, we don't like the 9 things you picked out, and they get their money back. But I want everybody who invests with us to be as excited as I am about what we pick up because you're going to be stuck with us for 5 years. I don't want anybody to be unhappy.
Yeah, it's like getting married for 5 years, right?
Yeah, basically.
So where do you see Ironton in the next 5 years, right? Since we're talking about the next 5 years, right? Is it growth, and is it more properties, and what does that look like?
Well, we do the long-term investment fund that I talked about. We do 2 of those a year. We usually takes about 6 months to get about 100 investors, which is our regulatory limit. I imagine we'll probably stay on that pace indefinitely, and then, we have a lot of demand for the income fund. So from a product standpoint, we'll probably continue doing what we have been doing. I imagine that our assets under management, the number of investors that we can serve, will grow over time through referral traffic.
Yeah. Yeah, it's an amazing platform. What I, again, doing my homework, what I've seen, definitely it's interesting. And how many people are working with Ironton right now? How many
There's about
employees
12
do you have?
there's
12?
about 12, yeah.
Okay. Okay. And each one of those, I saw you have a marketing person, you've got it all. You got all the right people in the right places, right?
Yeah, it's a full company, but, compared to running a brokerage that was the largest independent in Colorado, I had 43, 44 employees, 750 agents, doing 4,000 deals a year. Like, that was like an order of magnitude more complex. This is like I'm semi-retired by comparison. It's like really delightful.
Oh, look, I ran a team with 120 agents,
Yeah, so
let
you've lived
alone
all that.
750.
It's all the same.
Yeah, it kind of just gets to be the same thing after a while, right?
You just hire more
So
people to help you out.
yeah, so tell me about that. You've built two massively successful companies, Ironton and the
First
real
Alliance Title,
estate
yep.
company, and how did the real estate, how did you build that? I mean, that's just a simple question. How did you do that to get to 750 agents?
Well, when I got a managing broker license, I decided I wanted to build a group, and I initially thought I was gonna have about 200 agents, and it would probably take me about a decade to recruit them, and it took me about 6 years to get to 200, and by the time we were at 10 years, I think we were in the 500, 550 range or something like that. Um, there's a couple things that were catalyst to this, and this is really, judo is using your opponent's mass against them, and sometimes you have to use the negativity in the market against itself. So we launched in 2004. We had a couple of years of like a completely bonkers market from 2004 to 2007. And then for your listeners that are older, they'll remember that there was a huge real estate crash. The average home price in Denver dropped about 25% from 2007 to 2009. And the transaction volume went to almost zero for a while. So the government was actually giving checks to people to go buy a house just to try to restart the market. It was like just a complete debacle. Um, so what we did during that time period is we started off as an investor-focused firm, and I called realtors. I did a market study of show me the realtors that have had their income be stable through this huge downturn, and show me the realtors that were former high producers and are now producing like half of their commission income that they were getting before. And we called the guys with the big cuts and said, "Hey, it looks like the market's been kind of tough on you. We put together some research for how a realtor like you can restart their business. Investors are a much bigger part of the market now than they were in the past. Would you like to have the toolkit to be able to work with them effectively and replace all those owner occupant clients that are just not busy buying right now?" And we recruited lots and lots of agents with that technique. So there's been a couple times where that strategy was appropriate. We've had other times just where there was a stall in the market, and we would do some research and write a book. So I've written 13 books. I'm working on number 14 right now. 5 of them on how to invest in the Colorado market. We've done 2 of them on how you can succeed with different business planning practices that a lot of agents don't do. We wrote a book on AI about a year ago and how you can use that to enhance productivity. And every time you write a book and do some research on it, then you can just do a whole bunch of classes, invite people over and say, is your brokerage doing this for you from a support standpoint? And the answer is always no. And you can start a dialogue. So it's just really trying to find out what can I do to add value to the agents out there that are struggling, solve the problem, and usually they'll come join you.
It's almost elementary, and it's not any different really than going to get more clients to buy and sell houses,
Yeah.
right?
If you're an investor focused client, then you need to go to as many investor networking groups as you can and bring something of value every time you come, whether it's a study of here's what the rent trends are and the vacancy trends, or here's, a study of which fix and flip neighborhoods have the highest gross margin and the most activity versus the ones that are like not so attractive. Whenever you can circulate data like that, you become known as an investor, and then you're not chasing clients. They're magnetic. You're just attracting them to you.
Yeah, yeah. Again, it's simple. It's not easy, but it's simple,
It's
right?
just a lot of work. You just have to show up and do it.
Yeah,
But the path is not hard. It's just it's like losing 10 pounds. Like everyone knows the formula, right? You just eat a little bit less and go to the gym every day. You just have to do it.
it seems simple, and that kind of like leads into my next thing, right? So what build these two massively successful companies, right? What like your mindset and habits, like how did that? What was the biggest difference in your journey? Like, did you have to change a lot along that journey, or were you always kind of wired that way, or did you start to see things differently and then just build out this mindset shift and habits to get to where you're at now?
To be an entrepreneur,
Yeah.
I guess I always had an interest when I was in business school to try to build a company from scratch. And as I was an investor, couldn't find a realtor that I liked, and I wasn't very impressed with any of the brokerages that I saw. I thought, well, here's an underserved market. If all I do is bring sort of the business logic mindset I've got from my day job to brokerage and just apply that, like there'd be some percentage of the realtors and clients that would find it appealing, and sure enough, that was true. So then it's just like building a plan and doing the work, and then my goal has always been to try to hire great people and retain them on the staff side as rapidly as I can. So I'm only good at a small handful of things. I just need to try to focus on that and hire out everything else that I can as quickly as I can.
Yeah. So surrounding yourself with the right people.
Again, that's like a blinding glimpse of the obvious, right?
Yeah, you would think. Yeah, you would think. Yeah, you would think. And so doing all this stuff now you don't have the brokerage any longer. Um, you're semi-retired. We're gonna air quote that though, right? Like
I
that's
still
not
work
really
30, 40 hours a week. And so I'm not working 60 or 70 hours a week. So it feels like semi retirement.
it's cutting you cut yourself in half, right? Now you're only working 40 hours a week instead of 80.
Right. Right.
So what's the big plans for Lon? What's gonna be next for you personally?
Well, I'm writing a book right now on 1031 exchanges and then the
Hmm.
6 different categories of passive investment alternatives and then sort of the tax implications of them, reflecting this new tax bill that just passed a couple weeks ago. So getting that done and then putting together a packet of educational courses around that is, I'm hoping to get all that done in the next 6 or 8 weeks. I have a book for your listeners. If it's okay, I'll mention it. If you go to irontoncapital.com/elite RE, it should be pretty easy to remember. You can download our book on passive real estate investing. So it's a free link for you, so you can take advantage of that. I think just thinking like, what's the next set of classes after that will probably be my next thing I have to work on.
Yeah, because I don't feel like you're the type of guy that just sits around and watches TV all day.
The biggest thing to do is just to be talking to a lot of people, a lot of prospective investors or a lot of prospective realtors to find out what's going on in their market, in their world, and what are their friction points. And if you talk to enough people, you'll hear some recurring themes about what the problems are. And then you just have to be creative about thinking about how to solve the problems, develop a class, a book, and then bring that back to the people saying, here's how you solve the problem. And success is just about solving problems and listening.
Oh, I, that is such like a sigh of relief for me that you said that. Um, because as I coach and train agents across the country, that's one of the things I always just keep trying to like. If you can solve problems, right, and even if you look at the big investment firms, right, or private equity firms, right, any private equity firm, if you have something that solves a problem, they will invest in it. It
I'm in the problem solving business.
yeah. Yeah, and I almost think that's really what us as entrepreneurs are,
We
is
are.
we're yeah, I mean, that's just what we do. We figure out a problem, solve it, right? And again, I don't have time to hear, but I know what the problems are. How can you
Yeah.
fix the problem?
Yeah. So then it's just a question of, can you deliver it with the least amount of friction so it's a high level of service, you can charge a premium, or if there's not any way to differentiate, then it's a pricing game. But that's not as much fun. I'd rather be in the service side than the cost side.
Yeah, and the other piece to this is too, like for real estate agents, if you're just a real estate agent out there, meaning you're not doing a lot of investing, you're just selling houses, it's the same thing. You are solving people's problems, right? And whether you're working with investor clients or whether you're working just a client that's trying to buy a house, you are trying to solve their problem. They have a problem. They need a house to sell or they need a house to buy. That's a
Yep.
problem.
So actually, for your listeners, here's a problem if they're realtors they may be having. They want to get more listings. So can I give you like a 3 minute idea of how to do that?
Oh, please, please.
So one of the nice things about our long-term investment fund is that there's two share classes. One gets no depreciation losses and it gets a little higher preferred return, and the other share class gets a little lower preferred return. It takes all of the depreciation loss. And one of the great things about this tax bill that just passed is that it's given us a lot of 100% depreciation write-off in year one, or greatly accelerating the recognition of depreciation. So if you're an agent in a market, you probably know people who own rental property, and some of them might be frustrated with it. They'd like to sell, but the thing that holds them back is the terror of doing a 1031 exchange, trying to find a replacement, or they don't want to do a 1031. They just want to be passive. They don't want to deal with tenants anymore. So if you could solve the problem, how do I make this capital gains tax a manageable issue? You can get a listing out of it. So we can solve that problem for you. What they do is they take the proceeds from their sale. It's not a 1031 exchange. They just invest it with us. They take the depreciation losses that we generate, and those dollar for dollar will offset their capital gains. In some cases, we can wipe out the entire tax bill. More commonly, we can't wipe it out entirely, but we can make a huge dent in it, and we can postpone that tax problem for them. And they don't have to be an active investor. Now they can be passive, which is what they really want. So you can get a listing and we can get a client. So that's written up in that book on passive investing. So irontoncapital.com/elite RE, or I think my email is probably in the show notes. Shoot me an email. I'll send you all the info to help you out with that.
Okay. Yep. Well, definitely everything will be in the show notes for sure. But irontoncapital.com/elite.re.com and get the book. But that is it is. And I think this is one of the things that realtors can brush up on, right? And get to know this stuff. And not necessarily for themselves, but for their clients, right? Because so again, I go back to real estate agents, and outside of opening a lockbox and putting a sign in the front yard, what value do you bring?
You need to have a lot of value that they perceive as being helpful. It's interesting. We wrote a book on the future of the real estate industry about a decade ago, and part of that we did a survey of consumers, asking them a whole bunch of questions about their. We interviewed consumers that had completed a real estate transaction in the last 6 months. What did you like? What did you not like on the buyer side or seller side? And the number one thing that people want as a consumer from their realtor, they felt like they were not getting, was really strong negotiation skills. So if there's any one favor you could do to help yourself attract more consumer clients, get better at negotiating. There's lots of good classes out there. And then during your interview with the client to get them signed up to an agency agreement, talk about your successes with negotiation and what your structured approach is and what your education has been. And that'll be a huge differentiator if it's a competitive situation.
Yeah, and the negotiation piece is so important, and that's one thing a lot of agents miss out on. That there's too many. Everybody wants to do social media, or everybody wants to do AI, or everybody wants to do something other than talking to people.
It's a contact sport. Unfortunately, you got to be on the phone or taking people out to coffee or cocktails. But to get paid to take people out to coffee and cocktails is like a pretty great job.
It's not so bad. I have so many agents that tell me they don't want to do the phone, right? And I'm 52. That's how we cut our teeth, was on the phone. Like that was, I even joke with my two sons. I'm like, when I was a kid, I had to call a girl's house and actually talk to her dad before I got to talk to her. You know what I mean?
Right.
That was sales 101.
That is sales 101 and 201 probably.
Yeah, probably 201. But yeah, again, that goes back to that same thing of you have to do the work, right? You have to put the work and the effort in to get to that piece. So what's one piece of advice that you would give to a new real estate agent right now?
Gosh, if you're in a market that's got a lot of inventory available, and inventory is certainly picking up across the whole US. What I
Mhm.
did when I first got my license, and this is 2001, which is not a great time, so there was a ton of inventory in Denver then, is I picked out a different neighborhood each morning and I previewed 6 to 10 different houses to get to know each neighborhood. And I learned an awful lot. I would try to think as I saw those houses, if I had to buy one today, or if I was coaching a buyer, which one is the best deal and why? Which one's the most overpriced? What kind of price reduction would that need to have to be competitive? So it would be like the next one to sell in that market. And over the course of a couple of weeks, I saw, probably a little bit over 100 houses. And that data set did more to educate me than a lot of things I did in my first couple of years. I would do that. Just go see a lot of properties. And if you have a chance to get someone in your office to kind of like listen on how they do a listing presentation or a buyer consult, I'd certainly want to do that. Just the more you can do, the better. And then start going to a lot of networking events in a structured sort of way. Get a CRM right away. Use it every day.
Mm.
Which one's the right CRM? Anything you'll use every day is fine. Excel is not a CRM. Just buy something. It's not expensive.
Oh man. Preach.
Sorry.
No, that's beautiful. It's beautiful because that is what it is, and it's using the right tools, in your tool belt that are there and available. And in today's world, most brokerages you get a CRM when you sign up with them.
Yep.
That's one of the things I teach agents too is, and you own a brokerage. What are your thoughts on this? I tell agents they need to interview the broker and instead of the broker interviewing them.
Oh, absolutely. I mean, you should definitely try to meet with 3 or 4 different brokerages and understand what is the process for educating and mentoring a new agent, and then say, "Can you give me 2 agents who started in the last year I could go take out for a cocktail, and 1 agent who's been with you for 2 or 3 years who's really had success?" And I'd interview all those agents, and when you do that, you're gonna know for sure which one is the right one for you.
Yeah, yeah, and again, you've been doing this for a bit. So let me ask you this investing question: what's more dangerous, over leveraging or not investing at all?
Oh, wow. Probably over leveraging. I mean, if you're looking at like a 15 or 20-year cycle, you'll probably have 2 recessions during that 20 years. And it's so dependent on when you get started. It's like if you invested in 2010, right after the last crash, you could have put a nickel down and it was just like the best possible time to buy. And you could have over leveraged as much as you want. And you would have totally gotten away with it. On the other hand, if you would have bought in 2006, right before the huge crash happened, no matter how much you put down, you would have been kind of in a lot of trouble in 2008. Um, the timing on when you choose to invest through the business cycle is really, really critical. So if you're not really confident where you are in the business cycle, I would try to put down more, or at least have more in reserve, so that if you're wrong, you're not going to be the one who gets in a lot of trouble.
So where do you think we're at currently?
I think we're probably like a year or 2 away from a recession, and I don't think it's going to be very severe. I think in most of the markets in the U.S. over the next 5 years, you're going to see that on average, you're going to see 2 to 3% annual average appreciation. Some markets more on the west, Austin, San Antonio, anything in Nevada, anything in Colorado. They've had so much appreciation that we could actually see a little bit of negative, 2 to 5%, nothing overly serious, and then things would go up a little bit. Um, so it's going to be just kind of a quiet market for probably the next 5 years. It's not going to be terrible. It's not going to be great.
Interesting. So you find some sort of balance there because we did see. I mean, and people have said, well, housing prices, but they skyrocketed so fast that and people are like, well, housing they have to come down. Like, well, they don't have to come down.
Well, what could happen is the house prices could be stagnant for 3 to 7 years while the interest rates stay about where they're at. Interest rates are not going to go down. Everyone tells you they're going to go down. They're not. We can talk about all that if you're curious. So if that's the case, that means the amount of transaction volume will be depressed through the next 3 to 7 years, and we're seeing that right now. Like we're selling about as many houses as we did 20 years ago, and new home sales are off by quite a bit from the last couple of years as well.
Yeah. What is your thought on rates? Where do you think rates are going to be, or what's going on with them?
So the mortgage rate, to really understand it, you have to know there's really 2 parts to it. There's the 10-year treasury, which the government, that's their main way of raising money to support the deficit spending. And then there's a risk premium that's paid over and above that. So if you take a look at the typical mortgage rate, let's say it's 6.7%, and the 10-year is at 4%, just to pick a number. The risk premium would be the difference between those two, which is like 2.7. Neither one of those 2 numbers is going to go down anytime soon, but they're for very different reasons. On the 10-year, we just passed a bill with a lot of pros and cons depending on your point of view. But one thing that's pretty certain, I think, for everybody is it's going to generate very large deficits. So the government's going to have to borrow a lot of money to fund that. And the only way to incent the investors of government debt to take on that much incremental debt each year is to offer a slightly higher interest rate to say, I want you to buy the government bond versus, Google's bonds. They probably don't even have any debt, but someone like that. So the deficit spending is going to put upward pressure on the 10-year. The risk spreads are high right now relative to historical because at one point, the Federal Reserve, during the early stages of COVID, there was this huge panic, and the Federal Reserve flooded the market with lots of liquidity so we wouldn't have like a crash. Definitely the right strategy. One of the elements of how they did this, they bought what's called a mortgage-backed security. So if you take about 100 different mortgages and rubber band them together and slice them up, that's called an MBS, a mortgage-backed security. And the Federal Reserve bought several trillion, not billion, trillions of dollars of mortgage-backed securities, and they currently still have over 2 trillion of MBS sitting on their balance sheet, and they're very slowly unwinding that position, which means not only does an investor out there have to buy the mortgage-backed securities of the mortgage for the house you sold today, they've also got to absorb these MBS securities coming from the Fed. So there's more mortgage-backed securities that need to be purchased than there's market desire to purchase. And the only way to balance the equation is the amount of the mortgage rate has to be higher to incent the investors to come in. As long as the Fed is sitting on a couple $1 trillion, and especially it's going to take about 7 years to run this off, that risk premium is going to be at historic highs. There's no structural way from a macroeconomic standpoint these rates can possibly go down. So we just have to learn how to adapt to this environment.
Yeah, and what people have to understand too is, the 20-year average for mortgage interest rates is 7% anyway.
Yeah, historically speaking, these rates are about normal. And if you
Yeah,
rewind on like a 50-year chart of mortgages during the 70s, 80s, and 90s, the mortgage rates were between 7 and 15%. And each of those years, we sold several million houses each year. So just because the rates are high doesn't mean you can't sell houses. It's just takes a little bit more creativity.
yeah, absolutely. My parents are in their 80s, but my parents say the interest rate's 17% on their house, right? Like it's like a credit
Yeah, in the
card.
70s, that's typical in the 70s for a period of time there.
Yeah. And you had to put 20% down. So you had to
Yeah,
put 20% down and pay 17%.
that was really a lot of headwind. The
Yeah.
thing that was great about that time period is if you took a look at the average salary relative to the average home price, it was like a 3x multiple, as opposed to today it's like a 6 or 7x multiple. So actually, affordability is harder today even than it probably was then.
Yeah. 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 And I mean, everything else has gone up too, right? Gas is
Yep,
$3, $4 a gallon, and as it was 50 cents a gallon. So we've got that to deal with. But that's interesting you say that about rates, because that's one thing that we keep hearing, right? There's these leaks that they're going to drop 2 this year. They're going to not, they were going to drop 5 times this year. Now they're saying they're only going to drop once this year. And it keeps getting pushed off, right? We're here in the fourth quarter. We're here in the first quarter of 26. We're hearing all these things, but they haven't moved yet. So
it's important to be able to explain to a consumer that the short-term rate, which is the only one the Federal Reserve really gets to control, does not set the mortgage rate. The 10-year Treasury sets the mortgage rate. And if the Fed is perceived as having a responsible approach to inflation, that will put a little downward pressure on the 10-year and every other bond. So they're doing a good job of that. But they don't have a lever for that. The short-term rate is what drives car loans and your credit cards primarily.
yeah, yeah, and again, the other thing is too, like, what are your thoughts on this? Because so this is kind of my explanation. Is I talk to clients who are thinking about buying right now, but they're unsure because the rates are higher and other things. But they tell us, if the rates were to drop a point tomorrow, you're going to get this flux of 3 million buyers into the market because everybody's going to rush back into the market, which
Yep,
then is going to skyrocket home
the
values again,
pricing. Yep.
right? It's going to
It'll
value.
feel like it did structurally in like late 2020 and all of 2021, where there was really cheap rates, way too many buyers, not enough sellers, and it was like multiple offers on every property. They'd sell above the asking price. You couldn't do an inspection. You might not even be able to do an appraisal. It was awful. Instead, what you want to do is buy the house now when it's not competitive. Be in a strong position as a buyer today. You can negotiate hard, and if we do see rates drop, you can refinance. Like it's a no-brainer.
And then the other thing is too, if we do get this flux of buyers in, and you buy now, you're going to gain that equity gains when their house values go up.
That's right.
Yeah, that's because I've got a couple of buyers that are, they're tentative and they're not sure about this or that. But I'm like, if you're going to miss out on these equity gains that could come if you think and I always play that, if you think these are going to go down, you're going to miss out on this, because those equity gains you're going to miss out on because you're not buying right now.
Right. I don't remember the exact stats. I'm going to butcher this a little bit, but you'll get the main point. The last time that rates were cheap and they went up to about 7% was like in the early 1970s. And there was a period of time, probably 12, 18 months, very similar to right now, where all the buyers were on the sidelines saying, I'm going to wait for rates to drop. It took 18 years for rates to drop. They were above the 7% for that whole time period. And meanwhile, the average price of real estate during that time period quadrupled. So don't make that mistake.
Don't sit on the sidelines for too long.
Yeah.
Yeah, it's incredible, and it's fun to watch. It's fun to be a part of.
Yes.
It's stressful, right? Like, there's some sleepless nights involved with being a real estate agent, and an entrepreneur building a business because, again, some of this is out of our control, and we have to try to play this game of, is this time the right time to buy? Is this not? What are your is there a not a time to buy for you?
Well, it's not a time for me to buy in Metro Denver right now because the cash flow just isn't there relative to the risk profile. So almost all of our investing is out of state, and that'd probably be true of other markets as well. So I think what you want to do, there's probably almost always something to be bought. It's just a question of figuring out what's the amount of risk, and am I taking a relatively appropriate risk reward choice with this decision? Am I in a position where I don't have to make just one choice? I can maybe make 10 investments and spread the risk across them because you're never going to get it right every single time. So you don't want to put yourself in a position to fail. You want to have a lot of little bets, and then it'll all tend to blend out.
Yeah. Yeah, and it's going back to the thing. What's the Here's a question for you. What's the craziest thing you've seen in a real estate transaction?
Wow, that's a really good question. Um, I'd say the most creative thing, that might be a more constructive way of answering it, is the first time I bought an office building, it was in foreclosure, and this is like 2015. And this building is in a great location in Denver. It's like $49 a foot is the asking price. So I went to the bank and said, I want to buy this and renovate it. And they said, you've got a great track record with multifamily. If it was a multifamily deal, we'd make the loan. This is your first office building. We're not going to do it. And I felt like Walt Disney, who legendarily went to like 40 different banks before he found someone who would fund Disneyland. He got told no. Same thing. So finally, I went to the foreclosing bank and said, "You want to sell this? I want to buy it. No one else will give me a loan. Can you give me a loan and a construction loan so I can renovate the property?" And they did. I don't know why I didn't ask them first. It was kind of a mistake. But they wanted more people on the loan to provide security to them than just me at the time. And a lot of your newer investor clients will probably have heard this as well. So I found three other limited partners who could, or they were not limited, they were general partners. So they were all signing the loan along with me. And what I did is I pre-negotiated an option contract with the other general partners and said, when the construction's been completed, which we thought would take about 11 months, and when we've got a rent roll that's gone from low to like this level, which would be pretty achievable at about 80% occupancy, I have an option starting on that date for a year to buy you out at this price. And at that price, you'll basically double your investment. Everybody signed the option contract. We got the thing done, and it took us like 11 and a half months. And I bought the building for a really good price. They all made a bunch of money, and the building doubled in value again over the next 8 years. So that was a really creative way to solve a problem. So I guess that's crazy in its own way.
That is crazy, but intuitive on your part, right? And did everybody cash out?
Yeah. Well, they didn't have an option. I had the option of if I wanted to cash them out or not. But if I said I'm going to cash you out, they didn't have an option. They had to accept. But we
Got it.
pre-negotiated the price,
Got it. So you
and we
cashed
set a
everybody
price
else
that.
out.
So we picked a price that basically everybody would get. If they were in the investment for like 18 months and double their money, it's like most people would be pretty happy at that.
Yeah, I wouldn't have a problem with that. I'd love for you to do that for me right now.
Yeah, exactly. And it was great for me as I couldn't have done the deal otherwise.
Yeah. No, that's incredible. And again, thinking outside the box. That is again too, like, that is one of the things about real estate, that you can get creative with creative real estate, right?
Oh, it's phenomenal.
Yeah. There in it On top of that one, what about residential? What's the craziest like residential one you've put together?
I'm working on one right now where a group of investors bought an apartment building and they really overpaid for it. The prices for apartments have dropped about 20% since the peak in late 2021, early 2022, and they really are in over their heads. So there's a glut of these apartment buildings in an undesirable neighborhood. So none of them are selling, and it's just like a knife fight to see who's going to sell next. And I told the guys, what you need to do is you've got to rate it like 3.5% on this, and it's good for like another 18 months. Offer a seller carry to make yourself stand out. But what you're going to do is you're going to do what's called a master lease. So you're not going to transfer title to the buyer until they can cash you out, and they've got an 18-month window in which they can do that. And the way a master lease works, if you're not familiar with that, is you set the lease payment to be equal to whatever that seller carry payment is. Let's say it's $7,000 a month. The new buyer is responsible for everything about the building. Everything they collect, they keep. They're responsible for all the expenses. They own the building effectively, except for on title. They've got all the responsibility and all the upside and all the downside. You are still responsible to the bank for the loan, but the amount you're collecting from the buyer is enough to cover the mortgage payment. So the benefit to this is the buyer can get access to 3.5% financing instead of 7.5% financing for the next 18 months. And they're putting 30% down just like they normally would. And if they default and don't perform, you don't have to go through the foreclosure process. It's a lease, it's not a sale. So the buyer's got a ton of skin in the game. I don't even think the buyer's like connected the dots on what they're signing themselves up for, but it was a really great way to solve this problem.
Right. You help the sellers out a lot.
Yeah, I'm on the seller side. I'm not on the buyer side. That's their
Yeah.
problem.
Oh man. Again, it's that creativity and what you're capable of doing with real estate. And
You
again,
can add
that
a lot of value through the negotiation and structuring process. To me, that's the most fun part of the entire project.
yeah. I mean, because again, it goes outside of the value, right? Outside of opening a lockbox or sticking a sign in the ground. What can you do for me as a realtor, right?
Right.
Because we are going down this AI, right? The Zillows of the world, Amazon's trying to get into the real estate game. Like, could you imagine just for salebyowner.com, it just becomes a partner with Amazon, and you just stick a sign in the ground and it's for sale.
Right. No, you got to be able to do something better than that. So, I mean, one probably emerging opportunity in a lot of markets is that there's getting to be too much inventory relative to buyer demand, and the number of withdrawn listings is really starting to increase a lot. But when you look at the stats, about 60% of withdrawn and expired listings do come to market again, and the majority of those withdrawn expireds, when they come to market with a good realtor, they'll come down at a lower price, and the majority of those will then go on to sell. Do you have a strategy to talk to a frustrated seller that was disappointed at the first time around? These people have raised their hand and said they're interested, and you go in the MLS and get a list of all these properties. Like, that's a bonanza, and I don't see very many people doing the work to take advantage of it.
They don't, and that expired list it gets bigger every day.
Yeah.
This isn't 2020, 2021 anymore. This is those days are past us, right?
Yep.
And again, it's having that conversation as on a listing appointment. I've got a couple active listings right now, and that's one of the things I talk to my people about, because it's this house. Typically, I could get pictures on Tuesday, coming soon Wednesday, Thursday, hit the market Friday, open house Saturday, and by Sunday I'd have 10 offers.
Yep.
That
Not
doesn't
today.
happen anymore.
Now it's a good time to be a buyer.
Yes. And that doesn't, and so especially, if you get some niche properties where it's going to be very slim on, because if we're talking $1 million, $2 million, $3 million, $4 million, your buyer pool is a lot smaller. It always has been, right? But now it's even smaller, and you're dealing with these niche properties that again, you have to market them correctly. And again, everybody's marketing with AI and whatever else they're doing with it. But again, how can you put this creativity into some use and put these deals together? Because that's all that the client cares about.
That's true. They want you to solve the problem, sell the house. And so that's a question of like, what things can you do that a typical seller can't? So I can communicate that you've got a different type of value. And once you do that, then you've made the leap. And then no one's going to care if you make, X percent. That's more than everybody else.
Yeah, right. Because again, and then I always go down the question, and you can understand this from an investment standpoint too, is what's their bottom line? Like, what do they need to get out of this property? Right. Like, don't worry about my 3% or the other person's 3% or whatever. What does the client need to get out of this property, to be able to walk away happily? What are they going to
Yep.
walk away with happily?
Right. I think there's probably a ton of opportunity to have more seller finance applied to the residential side, like that apartment example I gave you. And I don't hear very many people talking about that.
No, you don't. You don't. And again, that's one of the issues that we see out there every day. And you've been doing this for a long time, and again, coaching and training agents, and you've seen different markets, right? You've been through the 06, right? To 2010 to 2015 to 2021 to where we are today. And
Right.
I feel like today's market, like currently, is a pretty good, like almost a healthy market in a sense, right? We have,
Yeah.
it's not crazy where we're writing offers before we even see the house.
There's actually a lot of things that are very favorable about the market that we're in right now. By no means is this 2007, 8, and 9. It's way healthier than that. The number of buyers and sellers, at least in the Denver market, is almost in balance, and that hasn't happened in a really long time. It's very pleasing to see that buyers actually have a fair shot at the game. It's not just all one side of the seller abusing the buyer, and they can because there's no inventory. Um, it's like new information to because no one's got any skills to list a house.
Right.
You have to reteach all this stuff. But that's okay. It's an opportunity for us to be able to teach that stuff and run classes and recruit people on that.
Yeah. Yeah, absolutely. Absolutely. And I would say, the what was the biggest for you personally? What was the biggest book that impacted you, like that you read?
That I read? Oh, yeah. This is gonna be like a blinding lens to the obvious here, but Rich Dad Poor Dad was the first investing book that I read, and it totally shifted my entire mindset. That's probably the most important one.
I I agree. Rich Dad Poor Dad for me changed my whole outlook. And the crazy part for me is, I didn't read it until I was in my 40s. You know what I mean? So everybody says, "Well, when should I start? When should I do it?" Just start, right? Like
It's
it's
never too late to start.
it's never too late to start. It's never too late to start. Other than that, like what other book has impacted you a lot as far as your investing goes?
It's not a book, but it's a class. It's called Ninja Selling. Larry
Mm,
Kendall out of Fort Collins put together the sales system. It's on relationship sales. And I think for the vast majority of people who are attracted to real estate, that's a model that works really well for them. So you're just staying in relationship with people. They know what you do. You don't need to bludgeon them saying, I want to list a house. It just sort of happens organically. So if you can get everybody needs some sort of a sales system. It doesn't matter what the system is as long as it resonates with your personality. If you're okay making outbound phone calls that are cold, withdrawn expires might be like a killer in this market. If the idea of making cold calls like you'd rather shoot yourself, and that's the majority of people, unfortunately, then relationship sales like Larry Kendall's would be a great example. There's other ones. He's not the only one, but he's just the one I'm familiar with the most. Um, and then get a CRM and use it religiously. Interestingly, I've written a bunch of books on what makes what's the difference between a successful and not successful agent? The number one predictor, by far the most important, is the size of the network that the agent has and how often they're in touch with that network. If you tell me those two variables, I can predict their income pretty accurately. And it's something you can control. Get involved in more groups, meet more people, use the CRM so you're structured in how you follow up. Success will follow.
unbelievable. Again, simplicity is genius. And the,
Don't make it complicated.
yeah,
It's not about your brand. It's not about the brand of your brokerage. It's not about the color on your business card. No one cares about any of that. They want to just know that you know them and you care about them and their family, and they'll remember you when it's time to sell a house or their neighbor needs a referral. That's what wins the game. It's just that.
it's just that. Yeah, it's just that. It's incredible. It seems simple, and again, you think everybody would be able to do it.
It's a lot of work.
Yeah, yeah. And again, like I want to hit you with a couple more questions, but if you had to bet everything on one market over the next 10 years, what would it be? Where would you put all your chips?
Well, I'd put it in multifamily for sure. We've got a structural shortage of homes or housing units in America. We're somewhere between 5 and 7 million housing units short of what's needed, depending on which survey you take a look at. And we are finishing up a building boom of multifamily right now, but there's no construction of multifamily coming behind that for quite a while. So a little bit of you hear about distress in the apartment market or that vacancy rates are increasing and rents are flat or declining a little bit or concessions are up. That's all going to be gone in 12 to 18 months. There's going to be 36 months of absolute bull market if you're an owner of an apartment building or you're running an apartment building. And then beyond that, all of the structural tailwinds are in your favor. We still have population growth that's better than most industrialized countries. It's getting more expensive and more complicated to build. More and more communities are saying, not my backyard. I don't want any construction here. So the constraints on new construction are going to continue to be really harsh. It's going to continue to be very difficult for first-time buyers to be able to get into their first house, which means more and more people are going to be trapped as renters. There's going to be all this demand. Multifamily by far has got all these fundamentals that are just sterling.
Yeah, it's I've heard so many people say that, right? And again, it's and if you don't know where to go, right? Ironton Capital, right?
We do a lot of webinars. We do a monthly webinar on national real estate trends and the economics that drive it. Sign up. Just go to irontoncapital.com, listen in on our national trends webinar, and love to have you join us for that. We talk about this stuff all the time, and then it's in soundbite form that you can, parrot it out to your clients or your prospects.
It's incredible, and I will be joining you. I'm excited for it. It's again, it's another tool in the tool belt to be able to provide, one provide for my clients, but two provide for my family, right? Like
Yeah,
this is a big thing, and it's one of the things that I wish I would have learned when I was younger. But it's one of those things that I teach to younger people now, and my oldest son is 21, and I'm bringing him into this stuff. Like, hey, you need to start learning this stuff now, man, because this will change your future. This will change everything. This will change our family's future. This will change everything for us. And I didn't come from money. I didn't. My parents, my dad was worked in a factory. I'm in Detroit, right? So you just work in a factory. You work 40 hours. You come home and you work overtime and save some money. And
yep,
I read Rich Dad Poor Dad, and I'm like, that was a terrible idea, Dad.
exactly.
um. So now, if you could go back and give your 30-year-old self your advice, what would be the biggest piece of advice for 30-year-old Lon?
Wow, that's a really good question. I probably would have gotten out of active investing and got into passive investing sooner, in a much larger scale. I was a little bit. I could have done it 2 or 3 years earlier than I did. Um, and then I guess one thing I'm really glad I did do is I bought a ton of properties in 2009 and 10, and that felt risky at the time, but man, did that bet ever pay off. So sometimes you just have to realize like you're at a good buying opportunity. You just have to go out all out and do it.
Yeah, just put your Nikes on and just do it, right?
Yeah,
Yeah, yeah. It seems sometimes it seems again. It goes back to simplicity is genius, and it seems simple. So where irontoncapital.com, and that's where your webinars are. You said you do weekly webinars, and
yeah. We do one webinar every Tuesday night on different topics, and once a month we'll do the national trends. That'll probably be of most interest to your listener base. And then there's a sign up on there if you want to set up a time to talk to me or one of the people in investor relations. If you're just curious, like, here's my options. I'm not sure what to do. Set up a time to talk with us. If you've got that landlord who's frustrated, wants to sell, and you need some help from one of us to be on a conference call with that webinar to explain how we can help solve the problem and you can get a listing, set up an appointment and we're happy to walk you through all that.
so good, man. And again, it goes back to right the more we give, the more we receive,
Yes.
and how can I solve people's problems? How can I solve people's problems in Ironton Capital? You guys are helping solve people's problems not only from an investor standpoint, but from a realtor standpoint.
Yeah, absolutely.
Yeah, I love it. I love it. And so, Alon, I appreciate the time, my friend. These hours go by fast. People don't
They
understand
do.
how quickly an hour goes by. But I appreciate it. I would love to get you back on again.
Sure.
We'll get together and figure out a good time to get you back on and go from there. But irontoncapital.com. Lon, where else can we find you?
Lon Welsh. So you see it kind of spelled there on the screen at irontoncapital.com is a great way to reach me.
Got it. I love it. I love it. Well, irontoncapital.com, guys, /elite RE, and you get your book. And I appreciate you doing that for our listeners and going from there. So, Lon, I will talk to you guys soon. Again, thanks for listening to the Elite Real Estate Podcast one more time, guys. And join us again for our next episode.
Thanks for having me. I appreciate it.
Risk is the test, and we're always in class. Failure's just a stone, not a wall.